Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The debt ceiling deal has finally won the House passage, which has now significantly eased the US debt defaults. More on this to be covered by JK. On the other hand, let's focus on the real economy. The vacancies at US employers unexpectedly surged in April, possibly giving Fed some more reasons to remain hawkish. Labor market in the country has been tight for some time now, and it is closely being tracked by Fed officials. One interesting development is the recent warning by ECB that a shift away from low interest rate environment in Japan can really test the global bond markets. Good morning, JK. Must be a very busy day for you with so many updates. After this debt ceiling deal seeing through the house, what are some of the things markets will focus on in the coming times?
A lot, in fact, Swaraj. Good morning. Uh, so, I feel the long weekend, previous week, served as a trigger for an explosion of events and news that seemed to carry on till the coming Friday. And what we saw in the dead deal last Saturday seems like a much lesser event now when you look at the deluge of market moving economic news from across regions. Wednesday just carried on from where we left on Tuesday, and Chinese published their manufacturing and non-manufacturing NBS PMI that fell below market expectations, again well in contraction territory. Services expanded at its slowest pace in 4 months. These data are only the latest in the series of weak growth picture of Chinese economy, which I feel would heap pressure on Chinese central bank to ease more. And not surprisingly, Chinese yuan hit another new low in the current cycle, and authorities stopped making noise actually. Japan joined the big list of economies where manufacturing activities have been contracting. Into the European time, France and Germany joined Spain to announce inflation number that was much lower than expected, including the services inflation, which is a surprise after all. In fact, the month-on-month inflation in both these large economies were negative, giving a sense of disinflationary forces possibly taking over. A good thing about the lower year-on-year inflation was that it fell without any base effect advantage. And these numbers are also coming after a wide survey results for the euro area economy on Tuesday that painted a real slowness across parameters. And the Euro bulls are now nervously looking up to the retail sales from Germany and Eurozone inflation numbers later today. US data slate was thick too, but mostly on the weaker side. Chicago PMI, which assesses the business conditions and economic health of the manufacturing sector in Chicago region, dropped sharply to 6 monthly low at 40.4% in May versus 48.6 in April. This is the ninth straight month of contraction territory. At 40.4, importantly, it is below the level of index. The index was at for the start of 6 of the 7 recessions that have occurred since the inception of these data. And then the JOLTS data was better than expected as job openings increased from 9.7 million to 10.1 million. But when we look at it closely, gives rise to some skepticism. First of all, it's more than 1 month old, and the quits rate was lesser than expected, indicating that laborers wanted to hold on to their jobs with a sense of insecurity, not compatible with the strong jobs market. And there are also some concerns because historically low number of respondents to the survey. So we'd rather look at the ADP jobs number and the challenge of job cuts today for more clues on the monthly NFP number. And the Fed's Beach Book showed anecdotal evidence on the economy across Fed's 12 districts, showing the labor market remained tight, but there was some evidence in the labor market cooling across various districts. Some even reported they were pausing hiring. So at least some of these forward-looking surveys show that the economy is cooling, unlike earlier data on GDP, industrial production, and retail sales. So doubts have crept about the June move by the Fed. Looking at the various regions' economic picture, we get a sense of broad global growth slowdown, though US may, relatively showing some sort of good strength in some packets. And more doubts arose about a hike in June also when Philly Fed member Jefferson, when Fed members Jefferson and Patrick Horker, voters this year, said that the US central bank could skip rather than pause in the month of June. In fact, they ordered that a pause would signal holding for a while, and that did not know if it was time for stoppage of rate. So Fed funds features, in fact, now show June meeting hike has caved to 25% probability from 70% probably earlier in the session. On the markets, Treasury yields ended the Wednesday session at the lowest levels in 2 weeks, and the US Treasury yields, in fact, fell across maturities by 6 to 10 BPs. And the global equities were lower across regions as risk-off sentiment dominated the markets, with the broader global economic slowdown visualized. Also, some investors are still playing safe about the debt deal if it should face a last-minute glitch in pausing. On the dollar overall, Euro's weakness once again led the DXY higher, following a series of lower inflation numbers and weaker economic numbers over the week. Policymakers in Eurozone have expressed mixed view on further rate hikes, some calling for a hike in July, but not willing to commit a move beyond that. Those moderated expectations have been putting pressures on Euro USD, which has been supported due to policy rates going much higher for the last several months. Now, commodity currencies had little to cheer looking at the emerging economic picture across regions. Crude oil has fallen nearly 8% over the last 2 trading days, leading to commodity weakness. Yen was, of course, the best of the major currencies, clearly establishing a strong resistance above 140 for the dollar. I can see the market keen to cut longs on rallies, as we have increasing evidence of policymakers misaligned with the markets, on the weakness in yen. USD yen has made 3 days of lower closes, which technically puts it in a short-term bear trend. Dollar, of course, also retreated after 2 members preferred a skip in June. On the Indian side, macro data had a lot to cheer about. GDP for Q4 22-23 came far higher at 6.1% versus 5% expected, and 4.5% in the previous quarter. Full year GDP growth for FY23 was again, beating expectations, coming at 7.2%. The higher growth has been contributed by broad-based recovery from manufacturing, mining to construction and farm sectors, further aided by significant capex by the government. Outlook for FY24 growth remains strong at 6.5%, with a robust outlook for consumption and investment. So government data also showed lower fiscal deficit of 6.36% for FY23 versus target at 6.4%. With robust tax collections and capex, optimism about bringing down the deficit further to 5.9% in the current fiscal remains quite high. India's emerging Goldilocks scenario of higher growth and falling inflation has not got its due in exchange rate, although equities are reflecting the same fully. The big influence of central bank has stopped the market from expressing itself fully, but it is significant that the recent rise in dollar index has not seen the rupee fall further, and possibly seeing increased markets conviction about 83 level being defended strongly. So rounding up the overall and the long update for the day, I'm seeing opposition leader in the House, US, exuding confidence about debt ceiling extension, telling reporters that it is going to become law. On that positive note, we end today's update, but there's a lot to look forward to in the next 2 days also. Thank you.
Thank you, JK. And absolutely, a lot of data is also coming in, and we discussed a lot of data which has come in. Of course, the three major themes that are going on is, of course, the China's manufacturing PMI numbers, which were well in the contraction territory. So a weak economic data from China is, of course, putting pressure on the Chinese yuan. Inflation is cooling off in some European economies, but now fears of disinflation are creeping in into this euro area economy, which is putting some pressure on euro USD. If we observe the Fed fund futures, which calculate the rate hike probability, that has dropped to 25% from above 60% a day ago. While domestically, Indian GDP came in far higher at 6.1% versus 5.5% expected. We are seeing some lower fiscal deficit, but the higher growth plus low inflation has not caught attention in terms of the rupee movement. That's it from us today. Tune in tomorrow for another round of fresh updates. Thank you so much for listening.